Okay, welcome to another run through of the top 5 charts of the week. Just going to go through these 5 charts, add a little bit of extra comments and context. So starting off here, number 1, this is the combined market and official manufacturing PMIs. So just for clarity there, it's the MBS or National Bureau of Statistics PMI for China and the market one, and for the US it's the ISM and market combined. And you can see there that it's pretty clear what's going on. China has been in slowdown mode. I think it's the rebound there is probably a little bit too early to get too excited about that. If we look back at the 15-16 slowdown in China, where it was pretty much a recession, like with all the different indicators I look at, it was as close as you can get to recession for China. So at this level, pretty sketchy situation really. They're pretty close to recession. The slowdown that we're seeing here, if that continues, then that's just the logical conclusion. And that's why we've started to see a bit more stimulus out of China. I mean, it's pretty much the talk of the town at the moment, but I look at my stimulus indicators, they haven't really moved that much just yet, and that just reflects the point that they've decided not to go all in just yet. They don't want to go all in because there's a lot of self-consciousness, I guess, in China about the whole previous stimulus rounds, like the 2009 stimulus. Some of the current leaders there are a little bit, basically thinking, well, that was actually a mistake because of all the, excess debt and things that they had to clean up. I mean, the last few years has been basically a story of them trying to clean up the mess from that. So I think it's probably, we probably will see a little bit more stimulus there. The other complicating factor there is the property market. Property prices still rising. The moment that changes, then of course it changes the calculus a bit. But for now, we're bouncing off the bottom there. Again, back in 15-16, we did have a little bit of a bounce before it got worse again, before the final stimulus kick actually did come. But as for the link with America, there's no two ways about it. These two economies are linked. They they have that. There was that old idea about the Chimerica synergistic economy kind of thing, but just the fact that they're both subject to similar economic currents and financial conditions, all the rest of it, it's not too surprising to see America starting to fall down towards where China is. And to that end, the turnaround in China could be the point where America sort of regains momentum as well. But the other thing that we can't ignore as well is the trade issue. It's definitely had a very real impact, and this here chart, if anything, if nothing else, just goes to show how high the stakes are for them to get a deal done and get a good deal done, which remains to be seen. Apparently they're getting closer, and there's been some pretty good noises coming out about it, and the fact that they're not just rushing to get any deal done, but a good deal, is probably a positive sign. So watch that space. On to the next one, emerging versus developed. Pretty similar kind of chart here actually. It's the market PMIs combined across emerging and developed economies. First thing, since we're talking about 15-16, you can see there that it's worth noting in passing that EM had that good little recession back then. They haven't gone down quite as far this time because well, things are a little bit different this time, and actually one contrasting thing between these two charts, obviously China's a big part of emerging markets and America's a big part of developed markets, but on developed economies, it's Europe, Japan, the rest of DM have slowed a lot, to a greater extent than America has. And for emerging markets, EM ex China on the economic front hasn't actually been that bad. in contrast. So hence we've had, if you can just notice it there, a slight crossover. I think it's by about 0.07. EM composite PMI is actually at a higher point than developed economies, which is quite rare in the post-GFC period. Matter of fact, I was trying to look at whether there's a correlation between the performance differential here and EM equities. There wasn't really one, and if anything, it was actually usually a bad sign when EM was outperforming DM, because I guess the main period there where you had that was this 2012-2013 period where global growth was actually quite soft. So of course that wasn't actually very good for EM. So but I think the situation is quite different, actually very different now than from back then. Valuation story is still pretty decent. EM is turning into rate cut mode. They've got a lot of ammunition there in that respect. So I think, and also US dollar is looking pretty tired, that bull market. So I think that that this is a different situation to back then. It's always important to look at history, but it's very important, more important actually, to think about not just looking at old data relationships, but thinking, hang on, what's actually going on here? What's driving this? Because old correlations can swiftly break down when the drivers change. Number 3, this was a very popular chart last year when we had it at that little, if you can see where the mouse cursor is, where that spread between equity futures positioning and Treasury futures positioning was at its highest. Now just a quick word on the methodology behind this chart. So for equities, it's speculative futures standardized by open interest, and then we've taken the z-score of that to put them in comparable terms. Same thing for Treasury futures, it's non-commercials, net positioning divided by open interest, and then that the bottom part is just a spread between the z-scores. Now the point that I raised last year when I started talking about this was it was basically a compound bet. So what do I mean by that? Well, long equities is basically bullish growth and inflation, because that's kind of good for earnings and all the rest of it. Short treasuries is basically bullish inflation growth outlook, because bonds tend to do not so good in that kind of environment. And so you basically have a doubling up on that bet here, and that was when that peaked, was kind of like the peak of the reflation optimism fervor, and we had quite a notable unwind in that now. So I guess the question that I pondered there is, if they were wrong when they were getting too optimistic about reflation, are they now also being wrong in capitulating on that view? And I think that there's definitely possibly something to that. I think you pretty much, there's two ways that you can view the current environment, and in a benign or positive sense, and that is that the global slowdown that we're seeing is a benign slowdown, and or we're going to see a policy pivot. ECB is talking about easing, BOJ is talking about doing more QE, already talked about China, and EM central banks look to have turned the corner into a more accommodative stance. So certainly something to think about. And very similar note here, this is the State Street Investor Confidence Index. It's based on their custodian business. So they've got I think it's something like $30 trillion custodian business. That's where they look after the assets for fund managers, and obviously the fund managers are looking after that money, but they're actually held by State Street as a custodian. And so when you're a custodian, then you're basically going to, of course, see any time that something changes in the patterns of portfolios of your custodian clients, because if they say if the fund manager starts selling equities, then the custodian's going to see a bunch of money moving from one account to another, and that's how they come up with this index. Basically, when it's below that line, it means that institutional investors are de-risking or selling equities, and if it's above, they're increasing exposure. And so it's pretty much pretty stark there actually, how aggressively they de-risked into the correction. And so that was a mix of selling during the correction and selling at the bottom, and actually selling into the rebound. So there's a bit to that. So just the fact that global growth has been a bit sketchy certainly is providing cause for caution amongst these guys. And then a lot of political risk, trade war and Fed rate hikes, etc. And of course, we also had the government shutdown back then. So what's it going to take for these guys to come back? Probably clearing of that wall of worry. I mean, I think the other thing is that can't be underestimated is how a lot of the key decision makers in investment committees, they had their formative years during this, or at least they were definitely they're probably still in the same role back in 2008. Wasn't that long ago, and you don't want to be holding risk assets into some sort of bear market or financial crisis like that. Clients are very unforgiving of that. So it's kind of when you understand that sort of psyche aspect, you can understand why people would rather be wrong by holding too much cash, or being underexposed to equities, being wrong that way rather than being wrong by holding too much. So it's understandable, and it's important to understand these things, because it's people at the end of the day, and markets are not just numbers, they're people. So understanding that aspect can be quite powerful. Is there a risk, or is there a chance that they get dragged back in and become another wave of buying? Definitely that's a possibility. And because there's two ways of looking at this. One is it's smart money and that these guys are actually right and this is the end, and there's no way of actually knowing that, to be honest. There are some soft genuine softening in the data, and there is actually every possibility that this could be a bear. My base case is that it's not, but I'm not going to be sitting here thumping the table on that. It's risk management and shortening up the time frames a little bit it's probably a wise idea at this point. And on that note, I mean, if you have somebody in this kind of environment, because it is fundamentally uncertain and unknowable, really pounding the table, then saying that they know that this is a bear market or that they know that this isn't, they're either lying to you or they're full of something that starts with S. Last one, Twitter survey. So this is a survey that I run on Twitter, and every week I ask them, what are you bullish or bearish on equities for fundamental or technical reasons? See if I can pull that up. Here we go. Your equities view positioning is blah blah blah, and you can see that I've got the one for bonds as well. And what we've got here is the results for equity surveys. The fundamental bulls minus bears on the left, technicals bulls minus bears on the right, and look at those two together. Basically, folk are bearish on the fundamentals and reluctantly bullish on the technicals, which is this here one, the fundamentals one, kind of has some echoes in this chart here in terms of investor confidence being fairly low. And you know, not really much else to say about this one except that what I've written here. You know, again, while this bearishness could turn out to be well justified, it makes it plain to see that the pain trade is for stocks to go higher.